Hello everyone and welcome to this Family Building Society masterclass on offset mortgages. Rising interest rates over the past few years have increased mortgage rates, but it has also had a positive impact on savings rates, which could mean that offset mortgages could be beneficial to a growing cohort of customers. They work by linking a mortgage to a specific savings account, so the amount of money in the savings account can be deducted from the mortgage interest, leading to lower payments. The product has previously been underutilized and possibly misunderstood, but the changing economic landscape could mean it is a key talking point for brokers. In this masterclass, Paul Roberts, Senior Account Director at Family Building Society, and Nathan Waller, BDM at Family Building Society, will discuss the different kinds of offset mortgages, how it can benefit residential and buy-to-let customers, and then outline some case studies. There will be a Q&A at the end of the session, so submit a question by using the Ask a Question button, and we will do our best to get to you. So without further ado, over to you, Paul and Nathan.
Hello. Good afternoon. All right. So that should all be showing up quite nicely for everybody there.
Perfect. Thanks, Nathan.
No problem at all. I'll leave it to you.
Okay. So the presentation, the offset opportunity, how to make the most of offsetting your savings. So Family Building Society have had offset accounts for a while, and we are a little bit different in that we do have some different sorts for you and different ones available for your clients and also for family members to help you. So that can make quite a bit of difference. And as we go through the presentation, we'll explain some more about that. So today's learning objectives rather than objections. So knowing the different types of offset and how they can support residential and buy-to-let customers, understanding the positive impact that offsetting savings can have, and recognizing how case studies can help you identify customers who might benefit from this type of proposition. Who are Family Building Society? So Family have been around for 125 years. We are the trading name of National Counties Building Society, so it's still plenty of people out there remember us as National Counties, but we effectively started running the Family Building Society trading name around 7 years ago now. I've been at the society for just about 8.5 years, and I think Nathan's been around 6 years, and we've been here to help you for that length of time. So the key areas that we're looking at here, so we have some unique offset criteria, especially in the buy-to-let sector. We don't credit score our mortgages, highly important. We have flexible underwriters with able to give you individual lending decisions. By talking to us, we can try and tailor-make the case for your clients. And we have strong relationships with those underwriters that allow you to submit accounts, look at cases before you actually submit to them, so you've got the best chance of getting those cases through.
Okay, thanks very much for that introduction there, Paul. So I'm going to go through a little bit in regard to offset really in a nutshell, and really an overview of what that actually means and how it works. So ultimately what it is a client can put savings into an offset account that's directly linked to their mortgage. Now, the options they then have after that is they can use those savings to reduce the balance that's actually outstanding on that mortgage, and therefore they can look at offsetting their monthly payments, or they could be keeping the monthly payments the same and therefore effectively paying less interest overall and getting that mortgage paid off even quicker. One of the benefits to us as well is we can actually look to fully offset that mortgage as well. So if the client is fortunate enough to have a significant amount behind them, but they actually need access to that money, which is probably the most important thing. That what they don't want to be doing is hiding that money away. What they want to have access to is, if they need it, new kitchens, new bathrooms, or they need to give that money away for some reason, or they need it for something later on, they still have access to that whilst they are benefiting from a balance reduction or a payment reduction. It's suitable for those, as we said there, with family members. They want to support the client without gifting the money as well. So one thing that is quite unique to us is family members are able to set up an offset savings account that is linked to another family member's mortgage. So effectively, rather than them saying, well, here's an extra 20, 30 grand to provide an additional gifted deposit, they say, actually, you know what, I wouldn't mind keeping hold of that for a later day just in case. So all they do is they give us a call, set up the account, link it to that mortgage, and there's that done. The other options is for landlords, surplus funds that they don't require. They might have a slush fund. They might be saving for a rainy day in case things go wrong, or rental voids, or they know that in the next couple of years they might need to kind of renovate or do up the property after they've had tenants in there for a long period of time, or even for a tax bill. A lot's happening and changing in the buy-to-let market. So actually what they're doing is keeping that money away and putting it against their offset mortgage just for later on down the line when that tax bill does come in from HMRC at the end of the year. Self-employed customers as well. Typically, you tend to find they have lots of money coming in at one point. Their invoices come in. They might need to spend that money later on to buy more materials for their next job. But in the meantime, it's sitting in a current account that's doing nothing. Again, transfer that money temporarily into an offset facility, benefit from that rate reduction, the interest reduction or the balance reduction. And then when they do need it, they have access to it again. So the main benefits, as we've kind of covered for the offset, is effective use of those savings. Now, interest rates have historically been higher for mortgages than savings, while savings rates have also increased recently. The main thing that's important there is interest that they potentially earn from that could, depending on where that is, be liable to income tax, which could reduce the amount of money they are gaining by up to 45%. Now, by utilising those savings and putting into an offset mortgage, because no interest is actually physically earned, it will not be subject to income tax. So again, really making use of that money to the best of its potential. Improving the cash flow. As we mentioned earlier, landlords using payment reduction, they've got a potential increase for their net profit, and therefore they're gaining more on a monthly basis. Again, more income for them. Self-employed customers putting that money to the side to settle tax bills at set times, or as we said, they may not need the money at the moment, but their next job they might need to buy some additional materials, some additional tools, or something like that. But in the meantime, that money is sitting in a bank account. Offset it, make it work as best as they possibly can for them. And again, family, as we mentioned, we will allow up to 4 linked accounts. So it is quite a unique family affair. Now, that's not just on a residential mortgage, that is also on a buy-to-let one as well. So again, it could be the scenario, so well, we do have some surplus money, it's not doing anything for us, right, link it to their family member's mortgage and benefit from it accordingly. Okay. So, in a nutshell, how does offset work? It's kind of what we've covered off here. So take this as an example. You've got a £200,000 standard mortgage. They offset £100,000. And therefore, the interest that's only going to be due on this is for that £100,000. While still maintaining that 200 grand mortgage, as I'm sure you can appreciate, the interest that would be due on that is significantly lower. If they keep the monthly payment the same, that's more and more money coming off of that capital, paying that mortgage off sooner. If obviously it's on an interest-only basis, they have the ability to reduce that monthly payment and therefore benefit from lower monthly payments, especially at this moment in time where you are where people are feeling the strain a little bit more, don't necessarily want to start eating into their savings, but would much rather utilise it in a slightly different way. So, as we mentioned here in a case study, what we've just covered here, Mrs. B is looking to look at her next buy-to-let purchase. She's got £100,000 ready to go. Hasn't quite worked out what she's going to get, where she's going to buy it. Waiting for that right opportune moment to put that offer down on the right property at the right time. So while she is searching, rather than keeping it in a current account that's earning next to nothing, she's offsetting that mortgage on her buy-to-let one at this moment in time. Therefore, the interest is only due on that £100,000. And again, she still has access to that money whenever she needs it. So, as you can see here, a huge difference. What you are looking at there is a monthly payment reduction of £554 in the meantime. For the meantime, that's providing her with a significantly additional higher cash flow, and that money is coming into her bank account, which is more profit. It's reducing her monthly payment while she's not needing to buy it, so not found the next property to buy, and therefore is making the best use of those surplus funds while she's still looking. Okay.
Thanks, Nathan. So the next one we're looking at is offset with balance reduction. And so Simon's buying his first home with the support of his father, Bob, who's adding savings into an offset saver account linked to Simon's offset mortgage. So again, Simon borrowing £100,000 for a £200,000 property, it's helping him constantly with doing this by adding that additional savings in that Dad doesn't need to touch at this moment in time, but would still have access to. And that's the big thing here, is so many times you're actually gifting these funds away. This is there, rather than it being a gift, it's just a loan effectively, lending him the money for the time being to reduce the amount of interest and therefore the payment or helping get that balance down for a period of time. But at any point, Dad can get those funds back. Okay, so as you can see here, offset with balance reduction, offset savings goes towards reducing the capital, and the mortgage balance will reduce on a faster basis. And in the example we've used already, you can see that it would be repaid, instead of after 30 years, it'd be repaid early after just 15 years and 1 month, which is a saving of £230,000. That's a huge amount of money, and repaying that mortgage just about 15 years earlier. And then using offset to reduce payments in the short term. So they've got Mr. and Mrs. D, higher rate taxpayers with a large pot of savings. So again, we're using this 100,000 or the 200,000 example. But they can fully offset the mortgage using their savings. So they're borrowing 100, they can offset a full 100% of that mortgage, and we will allow them to do that. Here at Family, what we do is for the very first month, we actually take the first full month's payment. So it will always be that first month's payment. But as the mortgage is fully offset from the second month, the interest payment after that will be zero, and they'll only pay the capital repayment. But what we do is we will write to the customers each month to confirm their capital repayment cost. And how this one works is, if you can remember the old KFIs that used to be issued, it literally gave you a list of 1 to 300 if you were using a 25-year mortgage. And our mortgage will effectively take the capital payment as at month 2. So for argument's sake, if the interest on that mortgage was £100 in that month and the capital payment was only £1, that would be what we would do in the second month. And then gradually the monthly payment would rise after that until obviously you'd be paying more capital than you would interest, which is actually great again if you're wanting to keep those payments nice and low in the first few years. You won't be paying a huge amount off the mortgage, but it will be just reducing it very slightly, but it's keeping as much cash as they need in that short term.
Thanks, Paul. Appreciate that. So moving on to the next one, where we're looking at kind of using offset to improve cash flow, but also really to utilize different types of finances. So you've got here, Mr. G typically uses short-term finance to buy properties, refurbish it, flip it, repeat it. Each time he looks at kind of development finance, bridging finance, and sometimes even looks at second charges against other properties, things like that. And what this facility effectively looks to utilize is what he can do is refinance an unencumbered buy-to-let property that he's currently got in his portfolio on an offset basis. This effectively provides an open line of cash flow for the next project, and also for the next one moving forward again and again and again. So what it looks to do is refinance it, freeze out 100 grand to his next for his next property, buys something, develops it, sells it, or even refinances that one onto a standard buy-to-let. Once that money is then back in his hands, he then puts that money back into the offset savings account, and then effectively brings his mortgage to net zero. So that is then ready to draw on next time. Now, the main benefits of this here, especially looking at an offset mortgage with somebody like ourselves, is there's one product fee at the start to set that mortgage up to begin with. There's one valuation fee on the property that we have taken the charge over at the start. And depending on the age of the client application, that's up to a 40-year cash flow facility that they have access to. So saves them, relevant of the week before you're looking at how much they're saving on potentially on the interest element when they're offsetting that mortgage, is the amount of money they are potentially saving on fees in comparison to some of these other types of funding lines could be a significant amount of money as well. So all these different types of things all kind of add up and add additional benefits to the customer on this basis. So again, as we say, it's a 40-year cash flow. If he doesn't need it, or that next development doesn't come around straight away, you're not paying any interest. All you need is when that next property comes up, maybe at an auction, or they just happen to go something in the right place at the right time just comes up, They don't have to refinance, find the financing straight away. They just give us a call, transfer that money out, and off that money goes ready for that next purchase. And Paul.
Thanks, Nathan. So, our criteria here at Family. So we see lots of customers who struggle to get a mortgage with high street lenders. We don't have here credit scoring at Family Building Society. We actually genuinely pride ourselves on how we deal with cases on an individual merit. So yes, we do a credit check, but we don't credit score. So it very much helps those clients who perhaps have got a lower credit score or are relatively new to being landlords, etc. And we do make quite a bit of difference. The big things here are we offer payment reduction, available on both repayment and interest only for buy-to-let specifically. Balance reduction, available obviously for repayment. The option to change, you can switch, you can mix and match over time. At some points you might want to do the balance reduction, at some points you might just want to keep that payment to as low as possible or zero, potentially on a buy-to-let. And the offset saver account, here, nice, really solid criteria of up to 4 offset saver accounts can be linked to that mortgage. So it can be mum, dad, granny, granddad, brothers and sisters, etc., who try and help. And the fact that they can get that money back, it's not therefore just a gift away, it's effectively a loan for them. And at any point, the parents, grandparents, kids, etc., can pull that money back. Nathan?
Yep, the main things to also cover off here in regards to the criteria, it's available to UK residents. At the moment, we are not offering the offsets available to limited companies or partnerships. They are in personal names, but also in personal names at the moment, that's probably where they're going to be seeing the most amount of benefit from it because they can't offset these mortgage costs anymore. Or they get a tax credit back. But actually, by having this in their personal name now, they can significantly reduce their tax liability again and improve their cash flow. We can look, as we've mentioned already, up to 100% of the mortgage can be offset and no interest is charged for those months when it is entirely offset. Again, a significant amount of savings for them. We do allow overpayments, like most mortgages, so if they did really want to, they can start overpaying the actual mortgage balance itself rather than offsetting it. The extra money reduces the mortgage amount on which the interest is charged as it normally is. So they can kind of mix and match it. They can offset some of it and then they can overpay as and when they want to. If they have made overpayments on this, underpayments can be available to them because we've already got additional monies available to them. They can pick up the phone and give us a call with a prior arrangement and just reduce the payment that they need moving forward. So again, we're always happy for them to give us a call and have a conversation about their needs at that individual time.
Thanks, Nathan. So just some other key bits to our criteria. So for owner-occupier, as a general rule of thumb, we have a max loan-to-value of 80% loan-to-value, subject to loan size, and buy-to-let maximum is 70%. A few little bits here. We do have a minimum mortgage amount of 45,000 and a minimum property value of 120. So we're not looking for the really low-value properties, but we offer significantly higher ages compared to many other lenders. 95 at the end of term for owner-occupier repayment mortgages, using pensions, investments, a multitude of incomes to try and get you to there. And for interest only, the last time you can apply, so especially for buy-to-let loans, is up to 89. So that's the last time you can apply rather than when the mortgage would finish. And we'll still allow another 5-year term at 89 for some clients. So again, lending significantly longer than many lenders and often significantly longer than the high street lenders. Okay, we take earned income into account up to the age of 70. 75 we'll certainly consider for non-manual roles, especially for the self-employed where they've got a management structure in place, etc. Pension pots, we're very unique in how we treat pension pots. We'll now consider up to 90% of the pot value divided by the number of years you want to do the mortgage over, especially if it's 10 years or more. We'll also obviously take fixed pensions, limited company directors' salary dividends, but also remember, if they're a majority shareholder, then we will look to use the salary plus their share of profit, which can again significantly enhance the amount that we can potentially lend to those clients. We, of course, accept rental income. It's the net rental income, so please just bear that in mind. You'll see land and property, and then you'll see further on down relief for finance costs. We do take those finance costs off. And as I've already said, all cases are manually underwritten with no credit scoring. We listen to your story. We're not an adverse lender, but we do listen to the story of what that client might need, and we'll try and bend and shape it to try and fit it to what our criteria is. But you just have to talk to us. Talk to somebody like myself or Nathan or one of the other business development managers within the team.
Thanks, Paul. And I think also from speaking to underwriting and things and yourself recently, the very, very good USP is we can look to utilise where we're talking about pension funds and pension pots. We can look to utilise the money that is as an income for that we're using on that to offset the mortgage as well in the meantime. So not only can we look at the value of that at 90%, what they can look to do is that money they can then offset the mortgage even further with those funds available if they needed to.
Yeah, specifically where it's investments. If they're putting investments into that offset and it's a residential mortgage, we can use the money in the offset pot to potentially use as income for the case.
Yeah. So going on to the buy-to-let criteria, it can be on interest only or repayment if they so wish. Most of them tend to go down the interest only route, mainly because it's normally there as the investment, and what people are mainly looking for is either the capital growth or a better income on a monthly basis. So most of them tend to be on interest only, but it can be done on repayment as well. Available in personal names, up to a 40-year term, subject to the maximum age at application. So if you're looking for somebody looking for up to a 40-year term, it can really be quite beneficial for those that are kind of around about 42. We look at that is the maximum time we do 40 years, so that'll take them to 82 years old. And then after that, the term does begin to slightly reduce depending on their age at application. They have online access to that offset savings account, so they can draw that money in and out whenever they do need to. And as I said, it's easy access for those types of properties where they might be looking at doing a quick auction purchase, or one of their tenants has now moved out and they need to put new kitchens, new bathrooms in, a couple of splashes of paint and things like that. All these types of things, unfortunately, life happens, things get in the way. Tenants unfortunately don't pay or can't pay, or something happens to the property that needs a significant amount of investment. And whilst they've got that money in the offset, they can draw on it whenever they need to. Refurbs and unmortgageable property purchases. So again, rather than looking at the kind of bridging short-term finances and things like that, it's a good alternative. So there's quite a few of us dotted around across the country. We've got a BDM finder on the website, so by all means go onto the Contact Us page, put your postcode in there, and one of our lovely faces will show up. And you can always give us a call, talk to us. We're always available to have a chat. And then moving on from there, any questions?
Thank you guys so much for that. Yeah, if you could just stop presenting the presentation. Okay, great. Can see you now. That's fantastic. We've got quite a few questions coming in. I suppose just to kick off, offset mortgages have kind of not been a hugely popular kind of tool in the broker arsenal. Just wondering why that has been the case, and do you think that kind of popularity will increase and other lenders might kind of be more attracted to this area? I don't know who wants to take that first.
I'll let you
take it, Nathan. Thank you. Throw me under the bus straight away. Thank you very much. No, only kidding.
No, it's okay.
Do I think they'll become more popular? They used to be quite popular, did offset mortgages. There's just been less lenders who've had the product out there. They kind of went out of fashion when interest rates were 1% and 2%. But gradually, I think they will come back into fashion. And I think specifically for buy-to-lets, the fact that you can no longer offset the interest the same as you used to be able to do is very significant for landlords. Our offering, where you can actually fully offset that mortgage, is really useful. And for landlords to be able to build up a slush fund, for argument's sake, popping their rents into that account, or borrowing on an unencumbered property, popping it fully into the offset, we'll quite happily do that and use it as a slush fund for going out and finding new properties. It means they've got the cash there. They're not having to do bridging finance, etc. at some point down the line. And it's a time saver. One fee, £999 as a general rule of thumb on a case up to £500,000, rather than 1% fees for bridging, etc. It could make a difference for people. So do I think they'll come more into fashion? Yes, and I think other lenders will gradually come back into the market, especially with interest rates as they are.
Great.
Anything to add, Nathan?
Yeah.
No, I pretty much agree. As you say, a lot of it has been mainly driven by the fact of where you were looking at 1.5–2% interest rates in the market, but there wasn't really a huge amount of point in it. Whereas now, where you are looking at significantly higher rates in comparison, all of a sudden it does become a little bit more attractive. And as you say, most people as well, one thing I'll always say to as many advisors as possible is, when you're sourcing, look at the total cost overall. Sometimes look at these variable rates and discounted products and tracker rates rather than just the fixed, because sometimes the right product is there for the client, just may not always show up on sourcing based on what people are looking for.
Right. And you talked about buy to let there, and I just got a question come through about whether or not you lend to portfolio landlords, or do you have a maximum number of buy to let properties? I know that you said in the presentation that you lend to personal names rather than limited companies, but is there a kind of limit for portfolio landlords, or is it just not as common for them to have it in personal name?
I mean, this type of product really is designed for portfolio landlords ultimately, because it's generally those types of customers that do have the additional monies that are available. Because they'll normally have 5, 10, 15, 20 properties all producing a rent, and that money is normally just going into a current account doing not a lot. So it does really benefit them the most. So yes, we are perfectly fine with portfolio landlords. We don't background stress a portfolio. We effectively look at the property that we're taking the security over, and as long as the mortgage that we're taking is in personal names, then that's perfectly fine. It's all based on the individual, and we're always happy to have a chat and to see what we can do for them. They do sometimes have more than one. There's no limit to how many offset mortgages they can have with us either. So they can look to have a couple of different ones, depending on our exposure to their portfolio as a whole. But again, we can always have a look and have a chat about it.
Paul, do you have anything to add to that?
Just literally, there are no portfolio limits. If a client has 1,000 properties in the background, we would still happily look at that client.
Great. And I think what I found really interesting in the presentation was the fact you can add four offset saver accounts. So just out of interest, that's not something that's very common across the market, is it? That's just kind of like a very family building society specific thing. And I don't know if you could what kind of process do you go through on those offset saver accounts? Like, what do the additional members, what information do you need from them to be added to the product, if that makes sense?
So effectively, it's no different to setting up a new savings account for a new customer. All that we'll want them to do down the line is to confirm that they want it offsetting against their family members' buy-to-let or residential mortgage, but they would go through the same ID and address verification process, etc. But it's just specifically an online offset saver account that they're opening. And once it's set up, we can get it starting to offset the family members' funds. A husband and wife, just for argument's sake, and one of them might have £50,000 in savings that they're not wanting to touch, but at the same time, they don't mind offsetting the mortgage rather than getting a modest level of interest. I appreciate interest rates have gone up a little bit from a savings point of view, but actually, if you look what the value it could be potentially to offset the mortgage, they may want to do that if they actually knew it could be done. And that's often the case. People don't know it can be done, and we're one of a very, very small number of lenders who would let you do that.
Right, Nathan, do you have anything to add on that side of things, or?
No, pretty much that's covered it. It's a online application form, and the only additional information that they will need, other than they would do to set up a normal account, is the account number for the mortgage. Pretty much, because obviously we need to know that before we can set it up. So as long as they've got that additional information, then it can be done.
I've got another question come in, which is about whether or not you accept rent-a-room income at all on this kind of product.
No, afraid not.
No.
Good. Nice, very definitive answer. We like that. So another question, which is about, is there a typical balance required that means the offset is a better proposition than recommending the best true cost lender without offsetting? Just weighing up the different options, when would offsetting be better?
Do you want me to say that, Nathan?
I mean, ultimately, it depends on the rate that you're looking at for that customer, because as we all know, that different clients will fit in different lenders' criteria and circumstances. So really, is what you would have to look at is would be comparing our mortgage interest rate and the mortgage interest rate that you are looking for that customer, and then looking at how much savings they would need to bring that down and offset it. Now, the other question as well is you've got to look at the client's circumstance of where do they have those surplus funds as well. Do they have those surplus funds in a current account that's not earning them a huge amount of money? Then all of a sudden, everything is significantly better. Or do they have those monies in an ISA that they don't have to pay the tax on? There might be a slightly different consideration for that. Or do they have it in just normal savings accounts where they are going to be liable to income tax depending on their tax bracket? So it's a bit more of a financial advice decision as to whether it's going to be suitable for that customer or not. It's very difficult, if I'm honest, to give a very definitive answer to that, because it is such a varied answer. It depends on a lot of the moving factors.
It's no different, Anna, to any normal client. It's just literally each case it will be appropriate to each individual person that's getting the advice from the advisor.
And I suppose that's where family also comes in with the kind of really manual underwriting and that case by case basis, in the sense you can really kind of, as I think you said in the presentation, Paul, really, you want to hear the story and you can really kind of delve into the customer rather than kind of doing a more kind of computer says no approach, or very rigid. We've got a question about whether you can use the funds in the offset account to support affordability. So just don't know. I don't know, Paul, if you want to take that and kind of delve into that a little bit.
Yeah, this is one of the nice, and I'm fairly sure unique scenarios that we offer. So for argument's sake, let's say somebody wanted a £250,000 mortgage and they want to put £250,000 into the offset saver. We will use those funds in that offset saver as part of the affordability assessment. So for argument's sake, let's say they wanted a 20-year capital and interest mortgage. We would take 90% of the funds, 90% of the 250,000, and we divide it by 20, and we would use that as income for the mortgage. Now, my maths isn't fantastic at this time of the day, but that creates a good degree of income towards that mortgage.
Great. Nathan, do you have anything to add to that?
No, I was just trying to work out the figures in my head there. Whilst Paul was doing, I think it's about 12.5 grand, something like that, because you were looking at 250 grand, 90% of it is 225 grand. I weren't far off. Yeah.
I my calculator into my hand.
Yeah.
I was going to ask, with the offset saver accounts, is there a minimum or a maximum that can be in those accounts? So if you had 4, does there need to be is there a minimum threshold that needs to be in them, basically?
So £100 on the offset on that side of things. Which another unique thing about us as well is we set that up and we provide the cash back to set that account up at the start. So effectively, no matter what that client's applying for on a mortgage, they actually end up applying for £100 less than what they're applying for, because we fund that offset account straight away, because then that is then set up and ready to go, ready for them upon completion. The maximum, no, not really. I mean, ultimately, is the mortgage amount really is the best thing to offset, is that they can cover up to that amount of money as well. Great.
We've got another question here of if a family member offsets some savings, they will always be the legal owner of that pot of money. So, because I think you said this in the presentation, that it's a loan rather than a gift in that sense. I just wanted to reiterate that was the case.
Yeah, effectively, Anna, if the family member is offsetting, whilst it's there, it will offset. But if they want it back on Monday the following week, they're very welcome to take it back Monday the following week. It's entirely up to them. It can be offset for a week, or it can be offset for 20 years.
Nathan, do you have anything to add on that side of things?
Nope.
Great. Let me just we have a lot of questions coming in, which is really good. So I didn't realize that you could use the offset to improve cash flow as a kind of way as a alternative, I suppose, to short-term finance. Is that an area that you expect to increase kind of in the short term, because you might have landlords looking to kind of grow their portfolios, or might not be? Do you expect this to be an area that might grow?
We would expect it to grow. We also think it works quite nice in a blended approach and different types of funding lines for the customer. Sometimes it may not be suitable for this to be utilised for what they need. Maybe they need slightly more money than maybe they can get out of it at the start. But what they can do is use a blended approach and say, right, well, I'm going to get some of my money from this bit, some of my money from this, make it all work together, and it just gives them the additional flexibility, because a lot of as we all know, lending in general has gone through a lot of different changes over the last couple of years, just to say the least. And to be able to have something in the background that you can kind of rely on as a cash flow or a surplus amount of money, in my opinion, is invaluable. So, you've always got that there, despite what's happening around in the rest of the market. So you do have it. And I think for especially, as we mentioned, portfolio landlords, or those with that do short-term finance, bridging, development, flipping, all these different types of project style of things, they should have at least one of these in their arsenal of loans, really, and then they can decide when it's beneficial for them to use it or not to. If they don't need to use it for the meantime, offset the whole thing, and then they haven't got to pay anything, and it's there if they need to fall back on it.
Paul, do you have anything to say to that? Sorry, I interrupted.
Yeah. No, not at all. If you think about, they'll have repairs to properties, etc. They might have already built up a slush fund to do that, so they can use that over a period of time. Actually, then using those funds to offset in the short term, and being able to touch them whenever they need to do so, to go away and do some repairs to a property as part of the portfolio, but then rebuild those funds up again, and constantly offsetting the mortgage. It's kind of a win-win situation for a landlord to have that as a revolving credit facility, isn't it, really, at the end of the day?
Great. And in the presentation, I noticed that interest only on the offset is only available for buy-to-let. Is that right? And would you ever make that interest only available for residential?
So at the moment, interest only for buy-to-let, and it's capital and interest for residential. I can't see why in the future we won't look at doing interest only for residential as well. We do a lot of interest only loans as a lender anyway on our standard portfolio of products. So it would be a potential natural to move into that. So watch this space.
Great. And on the limited company side, because we've had a few questions coming in, asking if you do accept limited company, and I know in the presentation it said that you guys didn't. Is that something that you would kind of re-examine, as because limited companies are becoming a more popular way for landlords to kind of manage their properties? Don't know if Nathan, if you wanted to take that.
Okay. Again, it is something that will likely to be looked into. Moving forward, obviously the buy-to-let landscape has changed significantly from personal to limited. We do offer buy-to-let mortgages in the limited company space. It will be, again, a natural progression for that to begin to being looked into as that market evolves and changes. So all I would say to that is yes, potentially. It'd be something down to the product team to look to develop.
Paul, do you have anything to add on that side of things?
No, just effectively the same as Nathan. I think it'll be something that will be a natural occurrence over time, that we're in a position to do it. It's systems, it's being able to do these things, and it takes a bit of time, but I'd expect us eventually to come out with something like that.
And something I also noticed in the presentation is that family, which is goes up to a higher age than a lot of other lenders. So could this offset mortgage be quite useful for later life borrowers it could be another option rather than say equity release or that kind, or maybe something to add to a kind of like product choice, I suppose.
Yep, very much so. Just as an example for you, later life lending, somebody coming to us for a mortgage at 70, we would still potentially do a 25-year capital and interest mortgage. And if that client wanted to keep their payments lower or wanted to reduce that balance quicker by just using some of the savings that they've got sat to one side, absolutely we can do it. We already do a significant proportion of our overall lending in later life. These are standard mortgages. There's no death stress test on them. They're effectively just looking at what is their income today. And as I've just said, you can potentially use the funds that you're popping into the offset savings account to also help boost the income that the client's got to make that case affordable. So it's kind of, again, a win-win scenario from that point of view, that they bring those savings to us, but we'll still use them. Even though we might have used them separate, we'll still use them if they bring them to us and offset the mortgage with them.
Nathan, do you have anything to add on that side of things?
No, that's covered it quite nicely.
Great. And on the with the 4-member offset saver accounts, is that a limit that you guys would ever revisit? Would you ever kind of think about going higher than that, or is 4 is a good number?
I think 4 is a pretty good number in comparison. I mean, I think it's at the moment it ultimately it keeps things a bit easier for us that we've got a set amount of accounts we can link it to. I don't think we've had many calls of like 5 or 6 or 7 or 8 family members like wanting to do it. 4 keeps it as quite a nice round figure to start with. Obviously, if we end up doing loads of them and people are looking for more, then it could be something that we can at least feed back. But I think for 4 is quite a good amount of accounts at this moment in time.
Paul, do you have anything to add to that?
Just the same as before. It's always around demand. If all of a sudden there became a demand for wanting 8 people to be able to have savings accounts, I'm sure we'd look at it.
Yep. And on the relatives that can have those offset saver accounts, does it tend to be close family members? So, immediate family, or it can, godparents or other, I'd say like not immediate family members. Can they also be involved in this?
It's a fairly big spread, Anna. So you've got mums, dads, grannies, granddads, aunties, uncles, brothers and sisters, and step parents as well. So the modern family building society, effectively. So there's a good wide spread of people who can help.
Great. And I suppose just to start rounding things off, if you wanted brokers to know one thing about offset mortgages in family building society, what would it be? I'll go to Nathan first.
Main thing is give us a call and talk us through and see how it could benefit your customers. Get to just have a look at it. It's not a product that's suited for absolutely everybody, but there will definitely be people in your client bank today that would benefit from either an offset resi or an offset buy to let. So revisit those customers, have a chat, and open those lines of conversation. And I would say that's probably the most important thing. That you sometimes be quite surprised as to what you can do.
Paul, what about yourself?
I just said portfolio landlords straight away. Portfolio landlords, look at your portfolio. What have you got? Have you anything that's unencumbered or low geared that you could potentially expand with somebody like ourselves on the offset buy to let, and then see how it can work for that client? It's a multifaceted product. And on top of that, family members can assist as well. So just have a look at your clients. It's another way of being able to go back, review the client bank that you've got, and look at ways of helping them. And what a great way to pick up a phone call with a client and say, look at this, I've actually got this for you, and this is what it can do for you. And that is a great way to talk to your clients.
Great. Well, I think it's been a very informative presentation. I didn't realize that it can be used as a kind of alternative to short-term finance. I think it has really great potential for buy-to-let and also for residential. And it doesn't just have to be, it doesn't have to be, your doesn't have to just be limited to a kind of borrower. It can work for a very wide range of people. So thank you both, Nathan and Paul, for your insight today. I think we will be sending out the presentation after the event. So if you did miss it, or if you want to look over those case studies in more detail, then you can do so. And thank you so much for joining us today.